Traders, what's up guys? Your mindset. What if I told you that that was probably the #1 reason that you're not seeing success in your trading right now? All right, let's see if we can fix it. Let's talk about trader psychology. Roll the intro. All right, traders, what's up guys? Welcome back to the Top Trader channel. It's your head trader here, Cleveland Bishop. Hope you guys are having a fantastic start off to the week. It is Tuesday. US session just started about 2 hours ago and markets are pretty calm. And so I wanted to actually talk about, since there's not much going on, trader psychology a bit. This isn't a subject that I've touched up on too much on the channel. We've talked about risk management, we've talked about fundamental analysis, technical analysis, everything, but we haven't really touched on trader psychology. And this is really the bread and butter. As many professional traders say, you can know exactly what you're doing in the market. You can know exactly how to implement your strategy, exactly how to assess, certain instances from a risk management perspective. But if your psychology is off, even just the slightest, it can affect your P&L. Okay, and I want to show you guys literally exactly how your psychology can affect your P&L by giving you a pretty awesome example. All right, so before we get started, guys, look, if you are new to the channel, make sure you subscribe. All right, turn your little post notifications on so you guys can get notified every time we put out a segment. And if you like this, if you understand what I'm getting at here, and if it means something to you, like the video for your boy. I really appreciate it. All right, so what we're gonna do, guys, we're gonna use a live example, all right, a pseudo live example. We're gonna do a little bit of back testing, okay? But instead of back testing a strategy, we're actually gonna be back testing how we would have potentially rationalized things from a money management perspective. Now, here's the thing, hindsight is 2020. Okay, that's why, on many occasions, I don't really even like back testing. I always like to do future testing. But in this case, I do want to show you guys how I know your emotions can trigger you to do certain things in your trading that you probably shouldn't have done. All right, so for example, let's pull up some of our charts here. And we have a couple to look at. All right, let's take a look. I like this Euro CHF, for example, and I was looking at this one. I think there's some good instances where we can catch a pretty good move, but it has a decent amount of volatility, right? And so remember, volatility, we've talked about volatility before on the channel. That's just the random price movement, right? That doesn't give you any kind of real momentum. That can definitely start to freak some traders out. Okay, so for this particular example, let's say we want to catch a pullback down into structure. Let's say our structure is this random here structure at the low. We'll usually call this the launch point, where you'll see markets consolidate at a low and then break outside of that consolidation. A lot of times you'll see touches back on that area if you have a dry up of buyers up there at the high. Okay, and so let's say that's what's happening. Let's assume that we're getting our dry up because there's some type of structure here. Maybe there's some kind of fundamentals that are backing this market to slow down a bit. You're getting multiple failures at the high. Okay, and so now it's just all about the entry. Okay, so for us, let's say we're trading a little bit more, not conservatively, but let's say we want to see a little bit more confirmation that this market's turning over, and we want to see a break of this consolidation, because we know that if we get a break of this consolidation, we should have a nice flow sell side back down to that previous structure here. Okay, so we'll draw up our quote unquote entry right around that area. Here we'll make our entry special color. Let's make it white. All right. And so our quote unquote entry is going to be right there. This price area, by the way, guys, is the $13.94s. All right. And so now let's see what happens. Okay, let's tick along a bit. And then we get to see markets start to push. And then slowly but surely we get our first breakdown out of structure. Now, what we haven't talked about is the size of the trade you have on. So let's say you have a $10,000 account, and let's say I have a $10,000 account here. Okay, so how big of a position do you have on in this instance? I'd honestly want to know, before I say the position you're going to have on, I want to know what you would put on in this particular instance. So pause the video, comment down below what size position you're going to have on a $10,000 account. I'm really interested to seeing that. Okay. So if you've already unpaused the video, cool. Now I'm gonna say that you're gonna have on maybe a 2 standard lot size position. Okay, so you're gonna put on 2 standards. That's gonna be about $10 per pip. Okay, so not a bad size. You would think that 2 standards is pretty reasonable for a $10,000 account. All right, and let's say I'm a little bit more conservative and I want to have one maybe just 5 mini lots. Okay, so let's see where we're at in terms of a profit. All right. So looking at markets right now, currently, let's zoom in just a bit. Right here, if you have a 2 standard account, you're up around 40 pips or so. So you're up around $800. That's not so bad. Okay, now for me, 30 pips up, I'm technically only up right around 150 bucks. Okay, so I need a little bit more price move for me to get a bang for my buck. By the way, the full stop to entry spread on this one is 93 pips. So your full loss that you're willing to take in your portfolio is almost around $2,000, which is 20% of your account. Okay, now that is substantial, but here's the deal. If I was to tell you before you took this trade that, hey, your real stop here is going to be around 20%, many traders would say, okay, well, I'm going to liquidate early, so on and so forth. Okay, you would never usually risk 20% of your account, but if I told you if you have a $10,000 account, you're probably supposed to have 5 minis, maybe up into 7 to 8 minis on. Most traders do not put that kind of size on. So for me, I would really only lose right around $500 on this particular trade, which is, again, a pretty decent sized loss. It's almost a 5% loss. It's around 93 pips, but again, it's almost a 5% loss in the account. Isn't that amazing? Okay, so let's see exactly what happens here. You probably don't want to lose that 20% of your account. So what are you going to be doing? Probably aggressively managing the position, right? Okay, so if you're aggressively managing the position, let's say you move stops to break even because you're like, okay, I got my breakout. I'd like to move stops because, hey, look, I'm not dealing with, too many pullbacks. I want to be aggressive. So you move stops to break even, maybe even move stops a little bit into profit just to maybe knock something out real quick. Well, let's see what happens. Well, boom, technically you got stopped out. You were up 800 bucks. That felt great, right? But now you got stopped out for a potential break even or a potential small profit. Now me, again, I only have, a fairly small position on, so I can tolerate a retest back to my entry. That's not freaking me out any. I'm not too emotionally tied to that particular trade. Now, for some of you guys, you would have said potentially, hey, I wouldn't have moved stops yet. Okay, cool. So you wouldn't have moved stops yet. Well, then that means currently you would be trading at a about 25 pip drawdown, which means you would have lost so far maybe around $450. Okay, so $450 to the downside. That's not so bad. All right, now let's continue along here. Let's see if maybe you're still in the trade and you haven't moved stops yet. What would you have done up to this point? All right, so markets, they pulled back a little bit. They pulled back quite dramatically. Now they didn't hit where you would have been out of the market, which would have been up here at this high, if you guys remember. Okay, but they got pretty close. Currently right now, you'd be somewhat around a $1,400 loss. So 14% of your portfolio is gone just like that. And trust me, most of the time, guys, if you're looking at a $1,400 loss in your portfolio, guys, you would have cut that loss. Okay, you would have cut that loss. You would have said, okay, damn, I'm not gonna let this hit my stop loss. I'm gonna get out of this trade. Okay, now me, again, I'm looking at more or less maybe around a 4% loss in the portfolio. Again, and this is a pretty sizable position, but I just wanted to somewhat keep up with your two standards. Okay, but even still, I maybe wouldn't be out of this position yet. Okay, I maybe would have still allowed markets to do their thing because I know where my stop is. I know I'm not gonna move my stop. What's the most common thing rookie traders do? Their positions are so big, so what do? As soon as markets pull back within their structure, they may have a stop loss and where they want markets to stop them out, but if their position's so big, they'll start to move that stop instantaneously. Trust me, I used to do this all the time, okay? All right, so let's see what happens. Maybe you're one of those traders who can manage these ridiculous size positions in your two standards and you're like, dude, I'm fearless. I don't really care. Let it almost stop me out. I'm not doing anything. Well, if that's the case, hey, you maybe were rewarded for that. Now, me as the small trader, again, I'm pretty happy. The markets are now back in my favor. All right, I'm fluctuating right now at somewhat around a $400 profit. If you have one of those two standards, you're looking at close to maybe around a $1,200 profit. That's not so bad. So now at this point, what's your next step? Okay, we still have to hit our take profit, which let's say is right around here. Let's say at $1.13 flat. We're so close, okay? Most guys, again, you may see some traders start to take some size off here at this point. They may start to say, okay, I'm going to take a little bit off down here because it's really getting close to my target and I'm going to move my stops. It's now back inside of my price area. I'm going to move my stops. The reason why you're so rambunctiously trying to mitigate losses, again, is probably because your size is too large. And if you did move your stops, you definitely got whipped out of position and you never got your full take profit hit. So you took some size off down here at this low. Okay, maybe you just took off a standard. Well, if you just took off a standard, you only made $600 in that instance, and now you got completely stopped out of the market. Okay, because again, the market was about 60 pips in your direction on that extension right here. Again, not counting this. This is from the high when markets were in your stop. We're still looking at your entry right here. We'll extend it to the right. Okay, so that's your entry. You're right around 60 pips in the money. So if you pulled off some size, markets pulled you out, you're out of that move, folks. Okay, now again, if you're a little calmer, if you have on a smaller position, potentially you maybe even didn't move too much of a stop loss, and maybe you didn't even take some size off in that instance. A lot of times, guys, I'm not doing too much quote unquote trade management, because if I know what I want in a position and I know markets are very volatile at the moment, I know trade management is going to do nothing for me besides pull me out of positions I probably were going to profit in. Okay, think about yourself, for instance. There are probably many times where you have been in a position and you've been profitable and profiting that position, where maybe you move stops, markets pull you out, volatility, and markets race in your direction. So you ended up break even or at a small winner, when if you would have just let markets do their thing, they would have been able to hit your full take profit. Okay, so this is why trade management is a great thing to do in certain instances, but in certain environments, trade management is not priority. What's priority is patience, letting the market play out and letting your edge play itself out. Okay, we didn't talk too much about edge today, but long story short, you did get another pullback. Eventually markets pushed sell side. It did get us out of the position. Now, again, with that 5 standards, right around here, 5 standards, I made $500 on that position. That's not so bad. Okay, so again, it was right around a 1 to 1% risk reward ratio. The person with 2 standards, if they got out of that position right around here, they made $600 if they mitigated losses and took profits early. I made $500 on that less of size. Okay, so again, if you just keep hitting first base, guys, and not try to hit a home run every time you take trades, you won't have to deal with all the emotional price swings that this market can give you. There's a lot of turmoil to go to for just one single trade. You guys are going to be trading for the rest of your life, hopefully, right? So to get caught up in one trade and try to micromanage these positions is probably a bad idea. Okay, so again, your emotions are directly tied. This is what I was trying to get at the whole time. Your emotions are usually directly tied to the size of your positions. If you guys truly want to start being actionable and taking advantage of some of the opportunities that we're seeing, especially here in 2019, you want to pull some of your size off. Okay, you want to take down your size a bit and just let the market play out. Trade management is so over scrutinized many times, and of course we do trade management here at the Top Traders, definitely, but we do a logical trade management, not just based off of emotions and based off of what? The amount of capital. Okay, most of the times we were just assessing markets. We were managing our positions based off of how much money we made. The amount of money you make has nothing to do with how you manage a position. How you manage a position all deals with the current market environment, all deals with the current type of strategy you're implementing. There are rules behind it, right? So every time we were managing a position and you were agreeing with me saying, no, I wouldn't have taken it off there because that's not how I would do things around my money management regimes, you're actually still incorrectly doing it. You need to be assessing markets properly by looking at the actual structures at hand and doing everything within what you have written up for your strategy, not just based solely off of how much money you were making or not. All right. So again, you can calm down, you can pull back, you can relax a lot more, guys, when you have smaller positions on. Get that emotional side out of the picture completely. All right. By just playing a little bit smaller, hitting first base, not trying to hit home runs every time, and you will see immense performance increases in the portfolio. Okay, again, guys, emotions are everything in the business. Pull them back a bit and you guys will see a lot more success. Okay, so that's what we're going to talk about for this week's trader tips. If you guys ever have any questions, you guys can go to the link in the description and join the Top Trader Academy. Okay, we're going to be right here to work with you. All right, if you need anything else, let me know. I'll talk to you guys soon. Peace.